Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. In this video, we're going to take a look at scenarios for how the free charitable contribution deduction of $1,000 for single filers or $2,000 for married filing joint that's contained in the One Big Beautiful Bill Act could really work. So right now, under the current law, as you know, if you want to take a deduction for charitable contributions that you made during the year, you are required to itemize your deductions. If you take the standard deduction, then any charitable contributions that you made during the year are not going to help you from a tax perspective. So right here in this chart, we have a very common scenario that people face. We're looking at a couple that is married filing joint, and their standard deduction, if they're both under 65 years old, is going to be $30,000 for 2025. If one or more of them is age 65 or older, then each person will get an additional $1,600 bump, leading to a grand total of $33,200 for 2025. But right over here in this itemized deduction column is what a lot of couples face. They have mortgage interest, let's just say it's $10,000 for this example. They have state and local taxes, income taxes, property taxes paid. Let's just say that's also $10,000 for this example. And then they often have a certain amount of charitable contributions. Let's say that in this example, this couple tithes $200 a month to their local church or other place of worship. So $200 a month times 12 months is $2,400 in tithing or charitable giving for the year. Let's further assume that they don't have any medical expenses which reach the threshold for deduction. Again, the threshold is very high, 7.5% of AGI. Generally, most people do not have that much out-of-pocket unreimbursed medical. So here's the situation that people face. They have this $2,400 of tithing right here, but because their total itemized deductions, $10,000 plus $10,000 plus $2,400, only equals $22,400, they're going to end up being over here getting the standard deduction of $30,000 plus these extra bumps if they happen to be 65 or older, and so they get no tax benefit from these contributions. Now, under the One Big Beautiful Bill Act, there could be a change with respect to charitable giving. And that change, as I mentioned, is up to a $1,000 deduction for single filers or up to $2,000 for married filing joint. And the reason I call it a free charitable contribution deduction is because you don't have to itemize, apparently, in order to get this. In other words, you will still be able to take the standard deduction right here, but you will get some portion, potentially, of this charitable contribution in addition to the standard deduction. Now, under the current proposals, there's going to be an income test based on your AGI. So in this example, let's just assume that the couple has an AGI of $100,000. I am going to assume for this example a 1% of AGI threshold, just for illustrative purposes. Note that the final AGI threshold passed into law could be different from that, but for this example, we will just assume 1%, so 1% of $100,000 AGI is going to be a threshold of $1,000. So scenario number one right here, are your actual cash charitable contributions in excess of the AGI threshold? In this example, the answer would be yes. The couple has charitable giving of $2,400. Their AGI threshold for this purpose is $1,000. So if yes, deduct actual cash charitables up to the $2,000 for married filing joint limit. Therefore, the deduction in this situation is going to be the $2,400 actual versus the $2,000 maximum, resulting in a $2,000 deduction. Now, I want to emphasize again why I'm referring to this as a free charitable contribution deduction. And here's how you might consider thinking about it. Do you believe that this provision of the law, this additional $1,000 or $2,000 for married filing joint, do you believe that that will incentivize charitable giving that wasn't previously occurring? And my opinion is that it might at the margins. It could certainly encourage some people who are not otherwise charitably minded to go ahead and contribute $1,000 or $2,000 where they otherwise might not. But again, I think that's just going to be at the margins. Instead, the people who this is really going to impact, I believe, are those individuals who are charitably minded already, but who don't have charitable giving that rises to enough of a dollar amount to allow them to itemize. In fact, I would argue this right here is one of the most common situations out there, where individuals do have some level of mortgage interest, they do have some level of state and local taxes, and they do have some level of tithing or other charitable giving, but they just don't have enough to be able to itemize deductions. And so there's a lot of people out there with this exact situation right here. You tithe $200, $300, $400 a month to your church, or you otherwise do charitable giving in small amounts, $200 here, $500 there, and so on. It doesn't add up to enough to itemize, but the key is you're doing it anyway. You did not need this new provision to incentivize you to do it. You are already doing it. You're just not getting any tax benefit for it. And that's why I'm referring to it as a free deduction, because it is a deduction for something that most people are doing already, but previously they were just not getting a deduction for it. Now let's quickly take a look at another scenario of how this might play out. Right here in scenario 2, I have changed how the deduction could potentially work. So are your actual cash contributions in excess of the AGI threshold? In this example, the answer is going to continue to be yes at $2,400 versus the $1,000 threshold. However, right here, if yes, deduct the actual cash contributions in excess of the AGI threshold up to the $2,000 married filing joint limit. So in this case, the calculation of the deduction might work slightly differently. We would take the $2,400 actual contribution, we would subtract off the $1,000 threshold in this example, resulting in $1,400 of contribution that is in excess of the AGI threshold, and then we would compare the $1,400 excess to the $2,000 maximum, resulting in a $1,400 deduction. Which of the two scenarios, 1 or 2, is going to be how the deduction actually works when the law is finally passed? That is something we will have to wait and see what the final details are. These are just two possibilities of how the deduction might work based on the proposals that are currently working their way through Congress. One last question here. Will this deduction apply to non-cash charitable contributions? In other words, your donations to Goodwill, for example. The answer, of course, is still up in the air because the law is not finalized yet, but my guess would be probably not. We will review that question once the law is passed, but most likely they're going to want you to make a cash contribution in order to get this deduction. Now, for those of you in my personal tax planning template program who are working on your Roth IRA conversion calculations for 2025, this is another new item that we're going to be considering as an additional deduction for our Roth IRA conversion planning. Right here in this situation, considering scenario 1, you would have a $2,000 additional deduction for something that you are doing anyway. And that's $2,000 of additional deduction that you would not have previously received under the current law. So for purposes of our Roth IRA conversion planning for 2025, we're going to have to start factoring that in. By the way, if you are new to my channel and you don't know much about Roth IRA conversions, which is a tax planning strategy to smooth your income over time and get it out of your RMD years and into your Roth IRA conversion sweet spot years, make sure to check out my popular 2025 Roth IRA conversion and estimated tax planning videos. Some of the most popular ones on YouTube right now are how to calculate a Roth IRA conversion in the first place, how to think about RMDs in the context of doing Roth IRA conversion planning, IRMA considerations that every single person watching this video will be subject to when you sign up for Medicare starting at age 65, and of course how to make your estimated tax payments based on the safe harbor method so that you don't get dinged with unnecessary interest and penalties from the IRS. You can find links to these videos in the description below this video, or just search on YouTube for Number Crunch Nerds Roth IRA conversions. So that's going to be it for today's video, everyone. Thanks for watching, and I'll see you next time.